Hello and welcome to your weekly mortgage minutes. I'm Josh High here, broker at Swift Home Mortgage. I want to talk to you about the importance of watching out for your tax bill. So when you're out shopping for a home, or you maybe just recently closed on a home, you're going to find that in the next year or so, your taxes are going to be reassessed by the county. The county's going to look at your property, they're going to look at the house, and they're going to reappraise, mostly based off of the sale that just took place when you closed that home, or if you're about to close that home, that will happen in the future. That means that in an appreciating market like we've been in for a long time now, the value that you bought is going to be higher than the last person who bought it, the last seller that you worked with to buy that home. So over time, property values grow, and so do assessed property values. Now we're going to look at a real world scenario on a house that I found here in Fishhawk, right here in Hillsborough County, where the person closed on this house, the buyer closed on it in April of 2021. And then when their tax bill came out at the end of 2022 in November, they saw a gigantic hike to the assessed value, which in turn drove their tax bill up too. So take a look at these numbers and I'm going to show you what I'm talking about. So they bought this home April 21 and the tax bill was about $3,600, $3,686. After a while, they lived there, they paid their payments, they had their escrow account, they were basing their escrow account and their tax payment on that $3,686 number. And then come around November 2022, their taxes got reassessed because now they are the owner of that property and the sale was on record and the property appraiser at the county got in, reassessed the value, and the value went up to $74.56. So that's $314 a month that their payment is going to change and go higher than what they originally signed up for. So their taxes went up about $3,700 or $314 per month. Now the biggest reason for this increase was that the property appraiser at the county reassessed that value based on the recent sales price that happened back in 2021. They went from a taxable value of $133,000, which is what the taxable value was prior to the sale, and they adjusted that to $392,000 after the sale. Now, the biggest reason for this 194% increase is the fact that that prior seller, the person that this buyer bought the house from, had owned this house since way back in 2003. So 2003 was a different market than we're in 2021, or today in 2023. So all of those years of appreciation were capped because that prior seller had their homestead exemption filed on this house. And a homestead exemption will keep your taxes from rising more than 3% year over year. So this person had insulated themselves from a high rising property value market, and they pretty much stuck to the same value that they bought the home at least in the property appraiser's eyes. I put together a couple payment estimates. I want you to see what they look like when you compare the first payment that this buyer signed up for when they bought the house versus what their payment's going to adjust to after that property tax bill kicked in. It's real important for buyers and real estate agents to really keep a good eye on what's happening with these tax bills, because many times if you're walking into this process for the first time or it hasn't happened to you before, you might not know that you need to be looking out for these kind of things. Not all mortgage companies are going to be upfront and telling you about a potential tax increase in the next year or two to come. It's not an underwriting guideline, it's not a hurdle for us to get over in the loan process. So if you don't have a loan officer or a mortgage consultant who is very detailed and dialed in to the situation, who's looking out for your best interest not only today but in the future, you might gloss right over this and you might see your payment jumping hundreds of dollars if you're not careful. All we need to do as loan officers is take the current tax bill as it sits today, factor that into your debt to income ratio, and disclose those numbers on your loan quotes and your loan estimates. So we're not required to tell you what this may turn into in the future because we're not the taxing authority. We're not here to set those taxes. So all we can do is help you prepare for it, help show you how to estimate what your tax bill might look like in the future, and help you understand the process that comes along with this. How can you know what your tax bill is going to be in the future? There's really no 100% way to make certain that you know exactly where your tax bill is going to fall, but you can do a couple things. You can go to the tax assessor's website and you can do a property tax estimator based on the current purchase price of your home. One thing I tell all my clients about is you can go to the county website. that you're buying a property in, like let's say Hillsborough County's website for the property appraiser, and you can run their tax estimator tool that they have built in, and you put in your purchase price that you're buying today or that you just closed on if you already own the home, and then you can tell it if you're going to have a homestead exemption on there or not, if you're getting your $50,000 reduction, and it will give you a range, a high and a low range of what your estimated tax bill should be based off of today's data and today's numbers that it's looking at. Now, that's not 100% accurate. It's never going to be 100% accurate. That's why there's a range between a low and a high, but at least it gives you some sort of idea to really understand what you could be facing in the future. Another thing you can do is look at comparable sales in the area, looking at houses similar to yours that you're trying to buy or that you just bought that closed within the last couple years, and you can see where their current tax bill is, and that can kind of give you a gauge of where your tax bill is going to fall, and kind of a ballpark number what it's going to be. Again, not 100% accurate, but like I said, it's never going to be 100% accurate until that bill actually comes out and is payable. One other key thing to look out here is how long did your seller own the house before you either bought the house or you're about to buy the house if you're currently looking today. If this is somebody that's owned this home for 10 years, 20 years, 40 years, and they've been under their homestead exemption the entire time, you can better believe that there's going to be a massive shift in taxable value once you take that property over and you buy it at market value. So you're going to see big changes there. Another example of this is if you've bought a new home or you're looking at new construction and you're only paying taxes currently on the dirt, on just the lot. That's not improved property yet. There's no house existing. That property value is not there until the house is finished and built and complete. So you're going to see that old tax bill, and you're going to have that tax bill for a year or so until that November tax assessment comes out and you get your new tax bill in the mail. Now, as lenders, we are looking out for that on new construction because we're not going to let somebody walk into a trap and only pay $100 tax bill when we know that tax bill is going to be $5,000, $6,000 in the next 12 to 18 months. So keep an eye out for that. On resales, resales aren't the same as new construction. So with a resale, lenders all across the country are just taking the tax bill that's due today and not worrying about the future because it's not here yet. So realtors, as you're out looking with your clients, and if they're payment sensitive and if they really, every $100 counts in their payment amount, you really need to be having this conversation with them when they find a house that they like. If they see that it's been owned for 10 years, 15 years, that they are definitely going to talk about reassessment in the future, and they have to be prepared, because if I have a family getting into a mortgage payment and that payment's $1,800 and they're going to struggle to pay $2,100, we want to make that known now, because we don't want to set them up for failure or for missed payments or late payments or hardship in the future. That's the big thing that we're here to prevent. We want our families to have these loans for an extended period of time without any trouble when it comes to paying that loan. That's what the whole qualification process and underwriting process is all about. We want to make good loans for people who are able to afford them long term. So as you're out looking, make sure you're aware of it. This is often something that's just overlooked because it's not something that happens immediately. We could be 18 months away from a reassessment, and it's not a today problem, it's a future problem. So we want to make sure that we're getting ahead of that and educating our people on it. So any questions at all, anything you want me to ever look at, I'm here for you. Give us a call, visit getwithjosh.com to get all of our social links. We'd love it if you'd like and subscribe to our YouTube channel. We're putting in a lot of work here on this content. We would hope that you can find it useful. And if you do, go ahead and give us a like and subscribe on this, and we'll keep you updated. So thanks again for tuning in to your weekly Mortgage Minutes. I'm Josh High, and I'll see you again soon. Bye.